to put it bluntly, world financial markets are going to be saddled with the problem from late next year of having to use a lot of this precious liquidity that currently goes into stocks or gold or Bitcoin or risk assets generally. It's going to be sucked out to facilitate debt refinancings. And that is a problem.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was on this channel back in March, he explained that rising net liquidity was responsible for the surprisingly strong performance seen in both the economy and the financial markets over the past 2 years. And he predicted that these net liquidity inflows would continue, leading to even higher asset prices ahead. Well, here in the final quarter of 2024, things so far have played out according to his script. So, will the good times continue into 2025? Maybe not, says Michael Howell, founder and CEO of Crossborder Capital. To find out why, we'll sit down today with the man himself. Michael, thanks so much for joining us today, all the way from London.
Great. Hi, Adam. Good to be here. Much looking forward to the discussion.
Thank you. Yeah, this is going to be a very important discussion, folks, because Michael, I would say, has been one of the more bullish folks that I've talked to over the past 2 years, and really switched to the bullish side very early, way before most people that I've interviewed on this channel. And he stuck to his guns, and lo and behold, his record now speaks for himself. It sounds, Michael, and we'll get into the details of this, but it sounds like maybe the tenor of your outlook is now changing a little bit to become a little bit more cautionary. Am I correct on that?
Yeah, I think that's a pretty good assessment. I mean, I'm not bailing out right yet. I don't think we're going risk off. But I think the point is that financial markets look forwards. I mean, they're forward discounting mechanisms. Why are stock prices, risk assets going up today? It's really because they kind of like the environment they see or foresee really over the next 12 months. And therefore, to sort of assess the validity of an investment, you've really got to look at about a year and try and assess what the world economy or world financial markets are going to look like maybe this time in the fall of 2025. And it's around that time that I'm beginning to get a little bit worried about what we're seeing. As I say, it's not risk off yet, but I think 2025 is going to be a lot tougher for investors than this year.
Okay, and we're going to get into the details for why. Before we do roll up our sleeves on the details, just at a very high level, I think it's important I ask you the question I ask everybody here at the start here, given your shifting perceptions. What is your current assessment of the global economy and financial markets?
I think the global economy reasonably okay. I mean, we've never been in the recession camp for sure. Our assessment is that things are slow, but they're certainly not recessionary. And, you know, this environment is normally the best environment there is for investing. When you find policymakers trying to stimulate slow economies, you get a lot of liquidity in the system, and that tends to spill over into asset markets, and that's pretty much precisely what we've been seeing through this year. So I think that a slow economy is good. What we wouldn't want is either a recessionary economy or a particularly strong economy, and those two things are not great. In terms of how we see financial markets, I think through year end they'll probably be fine. I think the problem comes in 2025, and we can dig into the details of that in a moment, but it's really coming under 3 headings. I mean, 1 is inflation, 2 is China, and 3 is this so-called maturity wall that's likely to hit us full on in 2026, but markets may get a sniff of that as we progress through next year.
Okay, well, let's I guess transition into those, because your firm, Crossborder Capital, just released its latest outlook report. You've got some great charts in there. Hopefully, we'll go through a few of them. But you go through each of these 3 risks in detail in there. I got to say, I'm particularly interested to hear about the maturity wall, because that was something we heard a lot about a year plus ago, with higher for longer interest rates, and corporate America was going to start re-rating, and was it going to be able to survive the jump in debt service? And then that worry kind of went away for much of 2024. So it seems like you're kind of pulling it back onto the table and saying, hey, it wasn't sidestepped. It was maybe just pushed back in time a little bit, but we're coming up against it.
Exactly.
All right.
Yeah, there's no such thing as a free lunch. And, if corporations basically fund themselves, and they fund themselves at low interest rates, but those bonds mature in 2 or 3 years' time. It's 2 or 3 years' time. We've got to be nervous, not right now. They cleared the decks near term. They funded themselves. But it's actually when that debt rolls over that is the big problem. And that's what we keep emphasizing here, is that with this huge, huge debt burden that's saddling the world economy, I mean, we're talking about $350 trillion sitting on top of markets, that has to be rolled over. And if you've got, simple maths, if you're talking about a 7-year average maturity for that debt, you've got to roll 50 trillion of debt every year. Now, the maturity wall is, if you like, push that out. So it's accumulating the 50 and it's pushing it further out. That's for sure. But ultimately, what we've got to do is come up to the table and refund that debt. And financial markets are no longer, as the textbooks claim, new financing vehicles for capital spending. They're actually refinancing mechanisms for debt, for this existing debt. And that's really the point. In a world of debt refinancing, a lot of things that people see kind of feel topsy-turvy. Interest rates don't work in the way that they should work. I mean, just consider what's happening with this huge debt load of the US government. The US government is now paying out, what, $1 trillion a year in interest payments. I mean, that's income for a lot of people, right? So if interest rates go up, they're actually giving money, income to the US economy. That's a transfer of money. That's one of the reasons why the US economy is strong, because these transfer payments are large, the government budget deficit is large, and it's very difficult to see a recession when the US government's running a deficit of 6% of GDP.
All right. Well, I can't wait to get into the details of this. One of the things about the maturity wall, and then I'll move on to kick off this topic proper. But I'm always amazed at sort of Wall Street's ability to ignore something that is just math related, right? As you said, there's no free lunch. We know the outstanding value of these debts. We know what their current debt service charges are. We have a pretty good sense of where interest rates are now and kind of where they're likely to head, at least in the near term. And you think somebody could just do the basic math and say, oh, well, this big bill's coming up by this point in time, and we should discount markets, X amount for that. But we just get so, I don't know, enraptured in whatever the narrative is. And right now it's, no landing, that we just kind of forget something that's pretty easily calculable.
Yeah, I mean, Wall Street only looks, I'm going to say 1 quarter ahead. I mean, maybe that's optimistic. But broadly speaking, financial markets, as I indicated, are discounting maybe 6 to 12 months ahead, that sort of time frame. They're not really so interested in what happens maybe 2-3 years out. That'll come into their horizons at some stage, but it clearly isn't there now.
Okay, so one of the things that I've talked about a lot, probably to the point where I've annoyed a lot of my viewers over the quarters, is the lag effect. The kind of, there is no free lunch. The central banks hiked rates up, Fed especially, very aggressively, held them there for much longer than we thought, or than everybody thought. And then now again, the narrative is back to no landing, and everybody thinks that we dodged a bullet, or in some ways kind of got a free lunch. We didn't have to pay the price of those higher interest rates. To me, something like the maturity wall is a manifestation of the lag effect. Yeah, it maybe took a long while to arrive, but it's the lag effect from, that hiking regime. You're nodding as I'm saying this, so my question to you is going to be, would you agree? Should we classify it as such?
Yeah, I think absolutely. I mean, I think what we've got to start to remember here is that pretty much since the GFC in 2008, there's been a lot more control of markets by the authorities. The Fed has come back into control. The Treasury is playing a very active role in terms of manipulating the Treasury market, let's say. And it's what we call not QE, and not yield curve control. I mean, this is happening. There's a stealth ease going on. But actually, effectively, the authorities are massaging these markets as best they can. And you can say, well, are they fixed? Maybe they are fixed, but actually they're fixed at the moment in a benign way. The problem comes is if markets derail, have the authorities got the ability to force them back onto the tracks again? And that really is a question. Now, a lot of it is about liquidity and how they control liquidity. And what our analysis really focuses on, or maybe starts with, I should say, is looking at the global liquidity cycle. You need context when investing, and global liquidity is one of the factors that drives markets. Now, I can show you, and I'm going to put a chart up which illustrates this. This is the global liquidity cycle. So this is an index, which is indexed to an average of 50, but it ranges between 0 and 100. It's a normalized series, and it looks at the momentum of liquidity, financial market liquidity, that is traveling through world capital markets. So this is not money in the real economy. This is the flow of money that is going through financial markets globally. And it's this which is driving asset prices. Now, the black line is the actual data. The red dotted line is a sine wave that we put through that data. It's not exact, but it was actually estimated back in year 2000, as it happens, using mathematical techniques. And we've just kept it rolling ever since because it seems to match up almost exactly with how the cycle has been evolving. And that is a 5 to 6 year cycle. Now, why is it 5 to 6 years? My simple explanation of that is that that 5 to 6 year frequency represents the turnover of debt. So it's the debt refinancing cycle. The average maturity of debts in the world economy is about that length of time. And therefore, as debt is rolled over, you get this cyclical movement. And that's what we're seeing right now. The cycle bottomed in October of 2022. It is slated to peak in late 2025. We've kept that narrative going pretty much since we turned bullish in October of 22, and we've been maintaining throughout that we're in a risk-on regime, and you've got to effectively, get into risk assets. And so we've liked equities, we've liked gold in particular, we like Bitcoin. All these instruments that benefit from more liquidity have basically moved up strongly through that period, and we still think there are gains ahead. The caution that we're getting is trying to look the other side of that inflection and trying to understand why markets potentially could derail. And that's really what I guess the discussion is about. Now, if we come on to this point about debt refinancing, what I want to do is to put a couple of slides up which illustrate the nature of the problem. So this chart in front of you is looking at, for the advanced economies worldwide, the effective world economy, let's say, is looking at two lines. The red line is what economists are always talking about. This is new capital expenditure in the world economy. This is what we need for productivity gains, okay? This is your new plant, equipment, buildings, etc., infrastructure, technology investment, all these pieces which go to produce output or raise the productivity of the world economy, the productivity of the worker. And that has been rising secularly over that period. One can debate about how fast, but this is, this is data that we've taken from the IMF, from their World Economic Database. The brown line that you see on that chart is basically our estimates of debt refinancing. And debt refinancing represents the amount of debt that is rolled over each year in global financial markets. So if we assume, for example, which is actually a heroic assumption, that all that new capex is financed from capital markets, in actual fact, only about 50% of it is. But if we assume that all of it comes from financial markets, what you can see is the ratio that we've indicated there between debt roll and new capex was 1 to 1 in 1980. In year 2000, it was 2 to 1. So in other words, 2 out of every 3 transactions in financial markets, at least 2 out of every 3, was basically a debt roll or debt refinancing transaction. And if you go to the current period, the orange is a projection for 2024, 25, 26. As you can see, what we're moving to is a world where you're at 4 to 1. So basically 4 out of every 5 transactions in global financial markets now involve a debt roll or debt refinancing transaction. So in other words, the whole nature of capital markets has changed. They are no longer new financing mechanisms. They're basically debt refinancing mechanisms. Now, if I go on a couple of slides to this one, and I'll have to explain basically what's going on here, what you're seeing is the ratio between total debt and liquidity, okay? And over time, since 1980, that ratio has basically been pretty stable at about 250% or there or thereabouts. So in other words, the stock of debt in the advanced economies by value is about 2.5 times the pool of financial liquidity. And financial liquidity is needed to roll over the debt. So in other words, what you need is financial institutions that have got the capacity to take on and roll debt. And that is what we broadly define as liquidity. Now, the solid line is that crude ratio. The dotted line takes into account the maturity wall. In other words, what it's saying is that each year, it's not, the roll when it comes is going to be concentrated in certain periods, which is shown by that dotted line. Now, the fact that the dotted line is below the 250% average and has been over the last few years is saying that we don't really expect, and we shouldn't have expected, any debt refinancing crises. In other words, there was enough liquidity to carry the world economy through. The problem is if we start to look into 2026, 27, that dotted line starts to go up very significantly. Now, I haven't drawn it in here, but in actual fact, take my word, it shoots up over that threshold of 250%. And what it does is it starts to threaten an environment where you may get financial crises. And that's really the concern we've got. So in other words, to put it bluntly, world financial markets are going to be saddled with the problem from late next year of having to use a lot of this precious liquidity that currently goes into stocks or gold or Bitcoin or risk assets generally. It's going to be sucked out to facilitate debt refinancings. And that is a problem. Either the authorities have got to step up with more liquidity, or we're going to have that liquidity taken out of existing asset markets. And that's really, the issue, the main issue that we're thinking about here.
Okay, that was fantastic. And I should have said this at the beginning, but I think when I first interviewed you, Michael, I sort of asked the question, we in the macro world, we look at all these different indicators, but the one that really just seems to be driving the bus dominantly is liquidity. And is it just all about liquidity? I think your answer to that has been, well, it's a little nuanced, but to a certain extent, yes. And to the extent that is true, liquidity has been this wonderful rising tide for financial markets for the past 2 years. So if I look at what you've just shown us, you're saying, hey, look, 23, 24, great years for financial assets. 2025, probably a less good year, not a bad year necessarily, but a less good year. And then 2026, 2027 could get pretty darn rocky because of this. And even if the central planners rush to the rescue with additional liquidity, I'm going to guess that's not going to necessarily be a pain-free process. There's probably going to be a lot of turbulence in that as well. So am I encapsulating your outlook correctly here?
I think absolutely. I agree 100%. We've got to remember this is a cycle, and I would argue that cycle is driven by liquidity. So it's a question of understanding what's the prospective supply of liquidity, and what are the demands or calls on that liquidity from not just financial assets, but from other areas. It could be that one call is debt refinancing, another call could be higher inflation, another could be what's going on in the Chinese economy. As it happens, those are the 3 risks that we think are paramount right now.
Okay, well, would this be a good moment then to kind of walk through each individually so you can help folks understand exactly what's got your attention on each of those 3?
Yeah, let me say that. I mean, what I'm going to do is I'll put up another chart just to, as if you like, a sort of way to step into the question, which is really looking at what's going on in the US in particular, what the Fed is doing. And what I'm also going to start to talk about is some stealth easing, the not QE, and maybe what's happening in terms of debt monetization as well in the US system. So let me just maybe go back to what the Fed is up to, which is basically shown in this chart here. Now, this is getting a little bit into the weeds, so you may have to bear with me for a moment. What we've got is an illustration in the big window of what the Fed balance sheet is doing. And the red line that you can see on the chart is the absolute size of the Fed balance sheet. The Fed is discussing its QT policy, quantitative tightening, in the context of the total balance sheet. So they're saying if that red line is going down, they are undertaking their remit of quantitative tightening. Okay. Now, I don't think that's good enough, because I think the reality is that the whole balance sheet is not a source of liquidity. Some elements create liquidity, some destroy liquidity. And what we've got to look at is the liquidity creating parts of what the Fed is doing. And that is shown by that orange line. And the orange line basically is what we call Fed liquidity. And it's a construction that actually originated from the days that I was at Salomon Brothers in the US through doing Fed watching. And it was something I wrote up in a book a few years ago called Capital Wars about how to construct this. But broadly, it's looking at the liquidity creating parts of the Fed balance sheet. Now, what you can see illustrated on that chart are a few lines, and let me just go on to what they mean. The dotted lines that you can see radiating downwards from those two lines are the original projections that the Federal Reserve said it was going to do when it was doing QT, right? We've deviated in terms of the liquidity line seriously from that, okay? And the two events that have really come into alter the Fed's vision is, number one, the British gilt crisis in September of 22, where, for those that don't know what happened, it was basically the UK sovereign debt market, the so-called gilt market, sold off aggressively after an ill-thought-out budget announcement in the UK in September of 2022. That was hastily withdrawn. The Bank of England moved with alacrity to change from its QT to a QE policy, but it was a wake-up call for policymakers generally to say sovereign debt markets are vulnerable to missteps. And the one thing overriding whatever the Federal Reserve and the Treasury do is to control the integrity of the US Treasury market, okay? Inflation and employment remits are secondary to making sure the debt market in the US, the Treasury market, is integral. They will do whatever it takes to make sure that market functions properly. And that's how you've got to think about US policy or any government's policy. The second movement was the SVB crisis in March of 2023, where you can see there was a very clear inflection. So the UK gilt crisis stopped the liquidity going down, and the SVB crisis injected a lot more liquidity into the system. And you can see broadly what's happened since. So as that line has gone up, you can see that liquidity is basically rising. This is what we call not QE. In other words, it's they say they're not doing QE, but actually they are. Now, the picture for the next 3 months looks to be quite good because that dotted line goes up. Why have we projected a pickup? Really for one main reason. That is that there's a debt ceiling likely to be or will be reimposed from January 2nd of next year in the US. That debt ceiling requires that the Treasury General Account, which is the Fed's deposit account the Treasury's deposit account held at the Federal Reserve, will be run down to normal levels. It's currently about 850 billion. A normal operating level has historically been about 250 billion. So you would suggest that there could be a sizable amount, maybe 500 billion, being injected back into financial markets as that account is run down. And that is a likely scenario to occur. So that may mean that US financial markets become more liquid through year end. One of the other things that the authorities have done, somewhat sous la table, is to say that the rules for stress tests that the banks have to undertake, US banks have to undertake each month, have been relaxed, or let's say broadened, so that the banks can now include in that access to the discount window, access to any loans from federal home loan banks, and also use of the standing repo facility. So in other words, they don't really need to hold so many reserves now at the Federal Reserve. So if you start to see bank reserves at the Fed dropping down, that isn't necessarily a negative sign. It's just saying that maybe banks' assessment of required or necessary reserves have dropped because they can now use those reserves in other areas and actually include them in their stress tests. So, for example, they could put them into the Treasury market, and that would still qualify because they could get an emergency loan if necessary by going to the standing repo facility or repaying those bonds and getting cash immediately. So, in other words, it gives a lot more flexibility. So what we're saying is think, not QE. It's happening, right? So aside from interest rate cuts, the Fed is operating here and it's pushing in liquidity. That's important.
All right, two questions. One, you might have said it and I missed it, but I don't know if I heard you mention the reverse repo program, but that's been another instrument that's been providing liquidity during this not QE time, correct?
Yes, that's absolutely right. Absolutely key thing to look at. It has, but the reverse repo has actually started to come up again, and that really gets onto another issue that I wanted to talk about, which is basically what the Treasury is doing. Now, what we've also got in the context of operations, I've spoken about the Federal Reserve. The chart that you see in front of you now is looking at something called the MOVE Index. Now, the MOVE Index is not going to be on most people's radar, I can assure you, but it should be, because it shows you the volatility in the US Treasury market. It's a measure, an index of volatility. Now, I read that, this is an index, but my reading of that, probably, crudely is to say, if you've got an index of 100, knock a zero off that, and that's telling you it represents about 10% annualized volatility across the curve, across the yield curve. 160 is 16%, 60 is 6%. So that's broadly how I read that. Probably precisely wrong, but it's approximately right. Now, what you can see in this chart is an elevated level of the MOVE Index. And you also see through there a normal zone. Why is the MOVE Index so important? Number one, it is the volatility of the most important asset worldwide, okay, the US Treasury market. Throughout history, the key asset to watch is the price of the dominant economy's debt. And that has been true throughout history. And right now, it's the US Treasury market. So you've got to look at how this market behaves. And certainly the Federal Reserve and the Treasury are looking very closely. What they would like to see is that MOVE Index lower. And I believe for a long time now, they've been targeting that. They want that down. That's one of the reasons that they've been playing around with a reverse repo, trying to get it down. That's one of the reasons they've been injecting liquidity. And it's one of the reasons that the Treasury is doing Treasury buybacks to increase liquidity in the market. A Treasury buyback is basically swapping what are technically called off-the-run bonds. In other words, stale bonds have been out there for a long time for newly issued bonds or on-the-run bonds, which are more liquid, have a higher price and a lower yield. And that basically means that volatility will come down as they increase market liquidity. So what you've got to expect is that to come down. Why is this so important? Because the MOVE Index, or collateral more generally, is the great engine of global liquidity creation alongside the central banks. Ever since the GFC, all lending now in the world economy is predominantly been collateral based. And that collateral is typically US Treasuries or German Bunds. Those are the pristine collateral instruments. You can obviously get collateral from equities and you can get it from other things, but the haircuts on those instruments tend to be quite high and variable. But these are the key things to look at, US Treasuries and Bunds. If you get lower volatility in the bond market, your collateral is effectively worth more. So that means you can get a liquidity expansion. So this is one of the things you've got to watch very carefully. And what the Treasury and the Fed are doing is trying to get this volatility in the system down. And this is a key thing to watch. This is way, way more important than looking at the VIX index. This is the key that almost drives everything. Now, that's looking at the MOVE Index. It's coming down and we've got to watch it. But the problem is there are pressures in the Treasury market being caused by the deficit and the whopping size of the deficit as we go forward. And that clearly is not a great thing for bond volatility or even yields. So this is how the system is coming under pressure. Now, what I want to do is to look a little bit further on to basically what is happening in the US Treasury market. And this is the first way of sort of looking at that, which is trying to get a gauge of how much the US Treasury is biasing the market. And what this is basically showing is the 10-year yield in orange, which is the stated yield on a 10-year note. And the black line is a synthetic estimate of that, which is taken from the agency mortgage market. Now, the agency mortgage market is a risk-free market like treasuries. It's held by the Federal Reserve in its portfolio. It's held by foreign central banks in their portfolios. It's considered to be as good as a treasury in many people's eyes. It's backed by the US government, etc. But it has a higher yield, typically. It has more convexity, and it has longer duration. Okay, all technical wonkish terms in bond speak. So what we've done is to adjust it back to make it comparable with treasuries. And as you can see, the black line and the orange lines on the chart historically largely overlap unless they don't. And when they don't overlap, something else is going on. And it's kind of head scratching as to why you've seen that huge dislocation between the actual 10-year yield and what the mortgage market or the agency market is really telling you. And that gap is very important in a number of dimensions. And the first thing I want to do is to explain why it's going on. And this is part of my explanation, which is saying here you've got, let me just run through what you're looking at on the chart. The black line here is the actual spread between 30-year agency mortgages and the 10-year US Treasury yield. The dotted line is my adjustment, rather like you've just seen, for duration and convexity. And the orange line is the rate of growth of Treasury bill issuance. Now, when you start to see big deviations between the agency market and the conventional Treasury market, it's normally because there is a scarcity being created, a shortage of coupon debt in the Treasury market. And that's because the Treasury is issuing a lot of very short-dated paper, like bills or short-dated coupons. And that is precisely what is going on. US Treasury bill issuance has soared, as that chart indicates with the orange line. But on top of that, Janet has managed to reduce the tenor of US auctions by around 1.2 years on average. In other words, the average maturity of debt available at the auctions has fallen by 1.2 years since the end of 2022. That's a big drop. So they're starting to issue a lot of very short-dated paper. Now, what implications does that have? I would argue it has huge implications for both perception and reality in the US financial system. Number one is, if the yield on the 10-year Treasury is genuinely as depressed as we would argue by this manipulation, it could be 100 basis points below where it should be, right? It's already trying to climb back there as we speak, but it's been artificially depressed. Add that 100 basis points back onto the Treasury note yield, and what you get is a no longer inverted yield curve, but you get a yield curve with a shallow slope, right? And what's more, it would have been shallowly sloped over the last 2 to 3 years. So there'd been no yield curve inversion and no economist jumping up and down saying, you're about to get a recession. Oh yeah, sure, you'll get slow growth, but no recession, because the traditional yield curve indicator has been biased by this manipulation. Secondly, what you're also going to get, as I'll show you in a second, is bias in the TIPS market, because break-even inflation is no longer 2% under this scenario, it's nearer 3%. So in other words, what is going on here is that traditional economic indicators are being distorted by what's going on. And the other thing which is upcoming is this picture, which is looking at US debt monetization. Now, one of the problems that you face, in fact, every country faces, and I'm going to keep stressing this, that I'm not hitting on America here, because America is largely the sort of cleanest shirt in the laundry. Okay, other countries, Europe, Japan, China, have far, far worse problems, right? But it so happens that the US system is very transparent, and America is very generous with data provision, so it's easy to look at. This is looking at US monetization. And one of the problems with issuing a lot of debt is, again, coming back to the fact there's no free lunch. If you issue a lot of short-term debt, who buys that debt? It's typically the credit providers like banks. If banks buy the debt rather than pension funds, it's monetization. It expands the bank's balance sheets. It increases money supply. And what this chart is saying here is that something like 3/4 of the increase in US money supply this year has come through debt monetization. In other words, the banks are buying agencies and government and treasuries, and that's why their portfolios or balance sheets are increasing. It's monetization. Milton Friedman will be turning in his grave if he's looking at these numbers. So this is stoking up inflation for the future. Now, if you take a look at this chart, which is the break-even inflation analysis, what it's saying is that if you look at that orange line, that is what the TIPS market is telling you inflation should be doing, okay? Now, just for the people that don't read this, this is what the bond market, the orange line is what the bond market is telling us as investors or the Federal Reserve as policymakers, what the implied 10-year inflation rate is in the US. And it's calculated by taking the TIPS 10-year yield, subtracting that from the conventional 10-year yield on a 10-year note. Okay, so the spread is 2%, saying that break-even inflation is telling us it's 2% over the next 10 years on average, right? Exactly where Jay Powell wants it to be. Great, tick that box. Unfortunately, it's biased. And it's biased because the Treasury note has been artificially depressed by what Janet al. have been doing. And it should be the red dotted line. So in other words, the red dotted line is where true US inflation is. And it's running at a level of above 3%. Okay. It's consistent with all this monetization. What's more, it's consistent with a University of Michigan inflation survey, which is shown in black. So consumers think that inflation is nearer 3%. And that's really what the number is. So what you've got to start thinking about more and more is that there's a distortion going on here. And you've got to, as an investor, think about monetary hedges in the future, monetary inflation hedges. You want things like gold. Why is the gold market at an all-time high? It's not, this is not rocket science. It's because there's monetization going on. Why is Bitcoin soaring? Because it's a very sensitive asset to monetary inflation. And this is what we've got. That's the problem.
If I could just interject for one quick second here, Michael. So this is sort of akin to because the central planners, in this case largely the Treasury, is deforming price signals. I use this analogy a fair amount, but it's not that dissimilar to a pilot flying by a faulty set of instrumentation, right? You're saying we're looking at that orange line, we're taking those signals from the bond market, we're setting policy based on it, we're setting lending rates based on it, and it is artificially low given where it truly should be for all the reasons you mentioned. Did I capture that correctly?
Yeah, but I think that what I would say is, and I've got no evidence to prove this, but I would surmise that policymakers know what they're doing. I mean, they're doing this deliberately, after all. Why has there been this shift in the tenor of coupon issuance or bond issuance in the Treasury market? Okay. Now, part of the reason, if you, to come down to why, is that that's where the demand is. Okay. So there is demand from banks and credit providers. Why? Because the federal authorities are spending so much money that they're providing a lot of transfer payments. Therefore, the banks are getting bank deposits coming into them, and they need to match those bank deposits with an offsetting asset. And the ideal offsetting asset is a short-dated government bond. So there's great demand there for that. And then you've also got the fact that if you look at who's buying US treasuries outside of the banks, it's to a very large extent hedge funds. It's no longer foreign investors to the same extent. We know that China has pulled back, and the appetite of foreign investors for treasuries is, under something of a cloud. And therefore, if hedge funds are buying so many treasuries, and they're doing this through an arbitrage trade where they're selling futures aggressively, and they're buying up cash treasury bonds as an arbitrage play, what they need is basically low volatility in the market. They get spooked if the move index jumps. So all this thing is sort of, it's a pyramid of cards, if you like. pyramid of playing cards, which looks, kind of dangerous in a way. But
Well, and that's where I'm going with this, which is, I mean, obviously there is no free lunch. One of the prices we're going to have to pay here is that, true inflation will out at some point in time, and so we'll have to pay that higher inflation when it arrives. But there's going to be losers here who are placing a bunch of bets based upon today's prices when things reprice, correct?
Correct. Correct. Yeah, absolutely. And it may be that, that comes later in 2025. Who knows? But, these are issues that we've got to be concerned about. And, if you've got a big maturity wall to finance 2 years out, you need liquidity. And then the Federal Reserve starts to realize that inflation is running away from it and it needs to slow down the supply of liquidity. Then you're clearly going to get a funding clash in markets because there's going to be need to roll over debt, but actually less liquidity there. And the point that I keep making, which is sort of as a contrary to maybe consensus thinking, is this is not about interest rates. If you're in a world of capital spending, I'll come quietly and agree that the rate of interest is something that's very important. It governs the capital spending cycle. But if you're in a debt refinancing world, it's all about balance sheet capacity and liquidity. And that's why liquidity is paramount to understanding how markets move. And they need to keep that supply of liquidity up. So one problem could be inflation. Another could be what's going on in China. And that's where I think, we can veer that in that direction. But that's another problem that we've got to try and face, that the world has to face.
Okay, well, let's go there quickly. What is it about China that plays such a key role in the future here?
Okay, let me get back to this. So the issue with China really comes back to understanding Chinese liquidity and maybe what the Chinese are up to when it comes to their policy. Now, if we take a step back and we look at the Chinese economic model, what you might call red capitalism is dead, right? And that model was one that effectively meant that China was overproducing goods, okay? And it was dumping those goods on Western consumer markets, okay? That worked well until it didn't. There was a big hiccup in 2008, and therefore the Chinese went down a different road, which was basically spending lots and lots of money on debt-financed infrastructure spending, and that was okay until it didn't work either. So they've now kind of run out of road because we've started to impose, led by the US, tariffs and controls on Chinese trade. And that presumably is going to get worse, not better. In other words, there's going to be more attempts to isolate China. Now, the Chinese clearly have a problem here because their whole economic model is starting to fall apart. They need export growth, or they need the ability to finance through debt infrastructure spending. And none of those two things work. And hence the Chinese economic model is starting to derail badly. And that's really the problem. The package of measures that the Chinese have announced go nowhere near trying to find a solution, okay? They're really sort of whistling in the wind here. There's all this talk about giant bazookas. There's no bazooka coming. Basically, what you're starting to see in the markets is that China is engaging fiscal policy to a small extent. I mean, they're talking about $1 trillion yuan, which sounds, big figures. But then go back to the financial crisis in 2008. How much did the US spend? We're talking about $2 to $3 trillion. Okay, so we're talking at something like 15 times as much spending. So the Chinese have got a bigger problem, and they're spending nowhere near as much. What's more, that what China needs is a monetary infusion because they're seeing debt deflation. This is exactly what economists who have experienced bubbles often go through. It happened in Northeast Asia, in Taiwan, Korea, in Japan in the 1990s. It happened prior to that in Scandinavia. It happened in Southeast Asia in the late 1990s. All these examples are of debt deflation occurring. And what you need is basically more money printing and a devaluation of the currency. That is what China desperately needs. The problem is we're getting nowhere near that because they don't want to let the yuan drop. They're trying to hold the line in the sand and keeping it around the 7 level against the US dollar. And all this fiscal spending is being funded through existing savings, unlikely to be through the printing presses, which is basically my solution. So what you've got is a Chinese economy that is facing problems. Now, what happens going forwards? The problem comes is if China squeezes domestically too much here. In other words, that they're spending lots of money fiscally, but they're not printing the money. So corporations lack credit. The last time this happened was in 2008, early 2008. Now, this is the narrative that I explained in my book, Capital Wars, which is not proven as a hypothesis, but it's an interesting one, so I'll lay it out. And that is that what happened in 2008, which was the trigger for the 2008 crisis, was that China also hosted the Olympics in August of that year, right? This was a showpiece Olympics that could not go wrong, okay? This was China's statement to the world. That Olympics needed to have a benign atmospheric conditions. It couldn't have pollution. So the Chinese turned down the volume of industrial production prior to the Olympics by squeezing monetary conditions. And the People's Bank of China started to tighten monetary policy in the spring of 2008. What happened was it forced Chinese borrowers into the Eurodollar markets. And they started to crowd out the Eurodollar markets. And the Eurodollar markets were basically running at full pelt, trying to finance mortgage-backed securities. Okay. And the whole thing basically fell apart. And that extra pressure was the trigger that caused, if you like, the whole deck of cards to fall in 2008. China wasn't the problem, but it was the trigger. Okay, there was a big build-up, as we know, of debt in the system, housing debt, and that was the issue. But the trigger in terms of the marginal financing dollar was interrupted because Chinese firms went there as the PBOC squeezed. What you're getting now is a similar situation.
Interesting.
And the problem you can see is if these financing demands from China start to escalate, then we've got a problem. Now, I'm going to show you a chart. This is the picture of Chinese liquidity using daily data of looking at their open market operations. Now, where that line, that white line, is high, there's by definition a lot of liquidity being injected into the system. When it's low or negative, they're taking money out of Chinese money markets. Despite what they've just announced, okay, and you can see the latest data here for October of 2024, they've actually been taking money out of the money markets. So at the same time that allegedly they're operating a bazooka, so-called, they're actually doing a squeeze. And that matters. Why does it matter? Because of this. This chart is showing those same liquidity injections in orange. And the black line is what is called a nowcast, which is a daily estimate of what world GDP is on the left-hand scale. So the orange line is liquidity injections in billions of yuan, renminbi, and the black line is the world economy. The orange line has been shifted forward by 3 months. So what the Federal Reserve does matters for financial markets. What the Chinese do matters for the world real economy and commodity prices. And that orange line is starting to falter. And our latest data, which is not on there, but over the last 2 or 3 days, shows that orange line starting to head south quite meaningfully. And that would suggest that maybe what you've got here is a hiccup in the world economy coming, commodity prices coming off, and maybe a lot more pressure being put on financial markets. So this is the issue, the other issue that we're concerned about. China is not operating the right sort of policy to correct its imbalances. Those imbalances are huge. At the end of the day, China is a dollarized economy, like it or not, the Chinese like it or not. But the fact is, Chinese banks have huge growth positions in the dollar, both assets and liabilities, and export trade and import trade is predominantly, or to a very large extent, operated in dollars. So this is why it matters for the world economy. China can have an effect here at the margin by demanding a lot more dollars, from taking a lot more dollars out of the system at times when it is least needed by the rest of us.
Okay, wow, super fascinating. So China is sort of this potential ticking time bomb here. Um, uh, in the remaining few minutes we have left, Michael, I want to move to your, basically your outlook for how to position for this type of future that you see coming. Unless there's anything else you want to talk about in regards to the maturity wall, because we went through inflation and then just China.
Yeah,
Um,
the maturity wall I covered at the beginning. That's already
yeah.
saying, what we've got 2026, you start to see a big problem. The maturity wall will start to, drain liquidity out of markets.
Okay. So, real quick, just on China, do you expect China will be forced to turn the money printers on and devalue the yuan?
Ultimately, but
Okay,
it doesn't look like it's going to happen near term. And
got
that's,
it.
the Chinese economy limps on, and that's the problem.
Okay. So we've got basically higher than possible, higher than appreciated inflation potentially coming. We've got this increasing anchor that China is placing on the world economy here, and we've got that maturity wall coming up. All of these things collectively, and for the reasons you explained, will conspire to challenge liquidity by the end of next year. So basically, we've got some time, a year-ish or so, to prepare for this. If indeed your cycle, continues along its historic path, how are you looking at how to position for this, especially through the eyes of a general retail investor?
Okay, I think the next 3 months will be okay. I think there's enough liquidity in the system. I think there is enough impetus to get more liquidity into the system near term, but markets will keep going up. Okay. The concerns, the ultimate concerns that face the whole system are this problem with fiscal or public finances that I've gone through before. But at the end of the day, what this requires over the long term is monetary inflation. Okay. So the trend we are facing, all of us are facing worldwide, is increased monetary inflation, because that's the only way politicians can square these huge demands on the fiscal purse. Okay. They've got to kick the can down the road. And
Right.
that is
And by
going
the
to
way,
happen.
that's their playbook. That's what they know how to do. That's their comfort zone, right?
Exactly. So what you're looking at is 8 to 10% per annum trend growth in global liquidity. Therefore, you've got to have structurally within portfolios dedicated monetary inflation hedges. A 60-40 portfolio won't do that. You've got to have money allocated into gold or similar monetary inflation hedges. And I've run through those before. Bitcoin probably is, okay? We don't know that for certain, but the evidence so far is it does respond to monetary inflation positively. Gold definitely does. There's 2 millennia of history to show that is the case. Prime residential real estate does that, and good quality equities do that. Okay, so that's what you want structurally in a portfolio. And I'd also say at these prices, tips, Treasury inflation protected securities look at steel, right? If you can get decent positive yields from these things, go for them. Because that, my benchmark is if you can get 2% real from a tip security, go for it, because it's very difficult in financial markets to get anything like 2% real anyway. So, that looks a great long-term investment, particularly with uncertain inflation. So that's what I'd hold. Now, we're then going to start talking about the cycle, because on top of that trend, we've got to remember that markets are cyclical.
Mhm.
And I would start to be getting a little bit prudent. Okay. Many commentators are becoming bullish right now, just when markets are at all-time highs. They should have been bullish, of course, 2 years ago, right?
Right.
And what I'm saying is, having been bullish over that period, I'm starting to get a little bit more cautious. We've had good gains. Typically, in a bull market, by this stage, you've already seen something like 80% of the ultimate gains in markets, right? On average. And I'm not saying this is an average cycle, but that's what
Mhm.
we've got to bear in mind. So we've got to steer carefully. And what I would be doing is effectively starting to build up some cash holdings in reserve for what could be a choppy ride as we start to move through 2025. Now, I haven't said anything about the political situation. I mean, I'm not a political commentator, but all I would say is that, having recalled what Trump wrote in The Art of the Deal. If Trump is the next president in the US, who knows, of course. If he is, The Art of the Deal says he negotiates by throwing hand grenades into the room and then closing the door. So what you can expect in 2025 is if he is there, there are going to be some hand grenades thrown into the world economy. So that's another thing to be slightly cautious. You probably want some cash through this period, or you want to hold, something like gold. I mean, that's another thing to start thinking about. So this is where I would be positioned. All I'm saying is that 2025 may not be a disaster, but it's going to be a lot tougher than 2024 in terms of making money.
Got it. And Michael, we'll have you on many times before we get there, but as best you can make out in the future right now, do you expect sort of 2026 to be potentially a down year, just given the liquidity cycles?
I think it definitely could. I think it definitely could be, because I think inflation will be more embedded. Policymakers will have to address that. The cynic in me says, of course, as well, is that what politicians have to do is basically sell Treasury debt. That's what they've got to ensure. So they'll probably like to create some sort of recession.
All right, Michael. Well, look, this has, again, just been yet another fascinating discussion with you. As I said at the beginning, folks, you really want to pay attention to this one. Michael has been one of the guests that I've interviewed over the years who has certainly called things most accurately, at least in terms of the big trends over the past couple of years. The fact that he is now beginning to become more moderated in his view of markets, especially when everybody's now sort of jumping in on the no landing, everything's great, central bankers easing again, happy days are here again, trade, that should really give you pause. And Michael certainly gave us a lot of great strategies to think about in terms of potential ways to invest for the type of future he sees coming. Michael, I will invite you on this program many times in the future, but you have an open invitation to come here at any point when your data is telling you something really important is going on. Maybe it's one of those hand grenades you talked about, or something that you think might accelerate or influence the timeline of what you're looking on. So please just feel welcome to come back on this program anytime.
Thank you, Adam. Enjoyed it very much. Thank you.
Oh, it was wonderful. Well, folks, look, if you've enjoyed having Michael on here and would like to encourage him to come back on the channel as soon as possible, please let him know by hitting the like button and then clicking the red subscribe button below, as well as that little bell icon right next to it. Last and most important question, Michael, for folks that have really enjoyed your analysis here today, where can they follow you?
Probably the easiest way is Substack. Our Substack blog is called Capital Wars. That's named after a book I wrote about 5 years ago about global liquidity. We cover institutional investors too, and the website is www.crossbordercapital.com. And there's a Twitter handle for the occasional tweet, which is @crossbordercap.
Fantastic. And Michael, when I edit this, I will put up the URLs there on the screen so folks know exactly where to go. Folks, there'll be links as well in the description below the video if you just want to get there with one click. I have subscribed to Michael's Substack. It is fantastic. Highly recommend you consider doing that. And it's not for nothing, Michael, that it's one of the top financial Substacks in the world. So congratulations for the important work you do. Well, look, Michael gave us, like I said, an awful lot of food for thought on how we might be able to position for what's coming along. If you decide you'd like some help in figuring out how to position your portfolio for that, highly recommend that most folks watching this get that help from a good professional financial advisor who understands all the macro issues that Michael talked about, which, to be honest, folks, when you add that last requirement in, the universe shrinks pretty quickly. If you've got a good one who can do that for you, great. You should work with them. But if you don't, or you'd like a second opinion from one who does, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me every week on this channel. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. There's no commitment to work with these firms. It's just a free public service that they offer. And last, if you're watching this today, this video releases, then there's only a couple days left, I think like 48 hours left, to get your ticket for Thoughtful Money's fall online conference. I won't go into the full song and dance because you've heard me do it 1,000 times, but this is shaped up to be our best faculty ever, probably most timely conference ever in terms of what's going on in the world and the markets macro-wise. Anyways, if you haven't bought your ticket yet, go run, don't walk, buy it at thoughtfulmoney.com/conference. Lock it in. If you can't watch live on Saturday, October 19th, which is the live day of the conference, don't worry. Everybody who registers will be sent a replay video of the entire event within 24 hours of it ending. And a reminder that if you are a premium subscriber to our Substack, you'll get an additional $50 off of the ticket price. With that being said, Michael, again, can't thank you enough. It's always such a joy to have you on. Just a fantastic discussion this time. Great food for thought, very important data. Really look forward to having you back on the program again soon.
Great, Adam. Enjoyed it enormously. Thank you.
Everybody else, thanks so much for watching.